when inflation rises and markets crash, cash has a high option value.
Cash is king, as they say. Welcome to another Breakout with Breaking Views, brought to you by PGIM. I'm Rob Cox. In London, I'm speaking to Edward Chancellor, who's across the British Isle from me. But Eddie, you're writing about inflation and the idea that all roads seem to lead to inflation. But your column is sort of like, okay, what are the implications of that? And what does one do as an investor? So let's start. The implications.
Well, where I look at it is that economists can't really agree about inflation and what causes inflation. But if you look at the different ways that the economists think about inflation, they all point in the same direction. So, for instance, you have the monetarists, the followers of Milton Friedman, and they point out the huge surge in the money supply and how that, an increase in 1/3 of the US money supply has to be absorbed into the real economy, and that'll cause rising prices. Another view holds that, hey, China has caused a disinflation, is responsible for the decline in inflation in recent years. But that it also seems to be changing because President Xi Jinping's Common Prosperity program is intended to boost consumption at home and doesn't care so much about exports. And one thesis that follows from that is that China will actually let export prices rise in future, and throw into the fact that we've had the global supply chains are changing and coming close to home. I think
they're like onshoring, so you have more locally produced or local sourcing. You also have, I suppose, decarbonization effectively means you're doing things closer to home. All of those things seem to be ingredients for inflation. And so I think in your piece, you point out that there had been this argument about whether it's transitory or temporary, but there seems to be a growing consensus that transitory for a long time.
Yes, but I don't think it really matters whether it's transitory or permanent. The point that many of these analyses appear to be missing out is they don't think how the financial system will respond to rising inflation. Now, think back, to the global financial crisis. At that time, the assumption of rising US house prices was built into all the securities pumped out by Wall Street, into the entire architecture of Wall Street. But now the assumption of low inflation and low interest rates is embedded in all the activities. It's embedded, investors have taken on more risk, the companies have taken on more debt and so forth. So the entire system, the entire financial system, which has grown to, in the US now, finances around 8% of GDP from 2% after the Second World War. This system is built around the assumption of low interest rates and low inflation.
So if interest rates go up because of these inflationary pressures, what happens and where do you need to put your money?
Well, the first thing, I think you have to be very cautious, because as inflation comes through, the danger is that the Fed is going to have to taper to lower its security purchases, and that will take liquidity out of the system. And if we face another taper tantrum, you can imagine we're going to face a lot of volatility on Wall Street. So I think the immediate near-term prospect is rising volatility. So investors have to sort of think about their near-term risk. But longer term, and this is a more profound effect, is that low inflation leads to people taking what we call duration in their portfolios. And what that really means is that their portfolios, whether they're bonds or equities, are more exposed to changes in interest. So, for instance, the duration of US corporate bond market is now at a record high. The duration of the US equity market is somewhere between 25 and 30 years. That's the sort of payback period it takes from buying an equity. And as interest rates rise, these long duration bets actually turn sour.
And so what do you do? So to close it off here, we're out of time. What do you do with your money?
Well, first of all, you reduce duration. And one way of doing that is you sell expensive US stocks and buy cheap value stocks in places like Japan or emerging markets or UK or Europe. That automatically reduces your duration. The other thing is, I think you probably want to get rid of the nominal bonds in your portfolios. You may still want to keep inflation protected bonds. And the final thing, and this sounds a bit counterintuitive at a time of rising interest rates, is you probably want to actually hold more cash in your portfolio, because cash, yes, it gets hurt by rising inflation, but it is the shortest duration asset. And when inflation rises and markets crash, cash has a high option value.
Cash is king, as they say. Well, thank you very much, Eddie, and we'll be back with another breakout from Breaking Views next week.
Thank you.